Yeah, here we consider again question 17 of April 2024 examination of CB2, that is business economics. Now we look at question 17, which is in a closed economy of the following information is given. The tax rate is 25% of the national income, and consumption expenditure given by C is related to current disposable income by the formula this. Investment expenditure is 100 million and government expenditure is 120 million. So which of the following statements is false? That if national income is 800 million pounds, then consumption expenditure is 500 million pounds. B, the equilibrium national income is 600 million pounds. C, the tax revenue at the equilibrium level of national income is 150 million pounds. And then D, that the multiplier effect of an increase of investment is 5. Now, which of the following statements is false? Let's find out. Well, in a closed economy, the following information is given. The tax rate is 25% of the national income. That's tax rate. Tax rate is 25%. Why? Where Y is the national income. Where Y is the national income. Then consumption expenditure is related to current disposable income given by YD. So disposable income is given by YD, and the current consumption the consumption expenditure, which we define by C, consumption expenditure, which we define by C, is equal to 20 plus 0.8 of the disposable income. Now, investment expenditure I is investment expenditure I is given to be 100. Now, these are millions, yeah? These are millions, yes. Then government expenditure, which we want to denote by G, is given as 120. 120 is given as 120. It's given as 120. They are all in dollars and they are millions. So we are asked to find, the question is, we find a false statement out of the choices that we are given. We are supposed to find a false statement out of the choices we are given, because choice A says if Y is at 800 million, then C is 500. And B says the equilibrium national income is 600 million. C says that the tax revenue at the equilibrium level of national income is 150 million. And D is saying that the multiplier effect is indeed 5. So we want to see which of those statements is not true, so that we answer the question. So first, we have the information given, but we know that in a closed economy, a closed economy is where it's an economy where we don't consider trade. The country does not interact, does not actually participate in international trade and financial transactions. And another thing, that means that it is immune from the global economic disturbances. And so in such an economy, we have disposable income to be given by, in a closed economy where we don't expect that economy to be participating in international trade and financial transactions, we expect the disposable income to be given by national income minus the tax rate. National income minus the tax rate. But then, that then should mean that is Y minus, but what is the tax rate? Tax rate is 25% of Y. So that is 0.25Y, implying that the disposable income is 0.75Y. So the disposable income is 0.75Y in a closed economy. And if that's the case, then it means that we can then specify the consumption function. So the consumption function, this should imply that if disposable income is 0.75Y, then we can then specify what the consumption function is. So it will be C is equal to 20 plus 0.8 times disposable income, which is this. So now here we have 0.75 of Y, like that. And upon working this out, you should get, upon working it out, you should get a 0. Of course, that should be, if you open up this bracket, what you should get is about 0.6Y. So just work it out and you'll see what it gives you. So multiplying 0.8 by 0.75. So we say what we have is 20 plus 0.6Y. I think that's now rounded off here. So that's what we have, 0.6Y, 20 plus 0.6Y. That specifies the consumption function. And then what else do we need? Let's see what the national income will look like, because what we need to see first is the value of the national income. So if we want the value of the national income, how do we get the national income? So first, we need to get what we refer to as the aggregate expenditure in the economy. So the aggregate expenditure in the economy in this case is, so aggregate expenditure, let me call it AE, aggregate expenditure in the economy will be given by consumption plus investment plus government expenditure. But then, what is that now? We know what C is, we know what I is, and we know what G is. So what is aggregate expenditure in this case? Aggregate expenditure then becomes C is now this 20 plus 0.6Y plus I is 100 plus G is 120. Plus G is 120. That effectively gives me aggregate expenditure as 240 plus 0.6Y. 240 plus 0.6Y. So that is what we get as the aggregate expenditure. But then we should note that if this is the aggregate expenditure, which is defined by this function, 240 plus 0.6Y, we note that in equilibrium, national income is equal to aggregate expenditure in equilibrium. So what then we have effectively is that this equation then should give us the national income. So it's 240 plus 0.6Y plus 0.6Y. y. So that means that I have y minus 0.6y is equal to 240. And therefore, 0.4y is equal to 240. Should then imply that y is equal to 240 divided by 0.4, which is 2,400 divided by 4. And that gives me 600. And so we see that the national income is 600. National income is 600. Actually, it is 600 million, and these are dollars. Those are dollars. Those are dollars, not pounds, dollars. I've been indicating pounds. I think they're there. Let me see. They're pounds. They're pounds. Those are pounds. Okay. 600 million pounds. Okay. Now, next, what I need to assess is look at what the multiplier effect looks like, the K, the value K, so that I can make my conclusion or my decision as to which of A, B, C to D to pick. So I already have that. I think the whole result here is here. So multiplier effect, where do I bring it? I think I already have. Let me just remove this. Just remove this. Okay. So multiplier effect, that is the K. K, which is the multiplier effect, is given by 1 over 1 minus MPC. And MPC is marginal propensity to consume. Marginal propensity to consume. And we should know that, well, we also should remember that MPS plus MPC should give you 1. That is marginal propensity to save plus marginal propensity to consume should be equal to 1. But then, what do we have here? This 0.8 here, the coefficient of the disposable income. This coefficient of the disposable income is indeed the marginal propensity to consume. Yes. So we say from the consumption function as such, MPC is equal to 0.8. Therefore, K will be 1 over 0.2, which is 5. So K is 5. We see that K is 5. And so my opinion on this question is that none of those choices was false. None of those choices was false. And so that particular question, that question students should have been given a free mark. Up to there, see you in my next video.